So we have to measure the risk. After identification, we have to measure the risk, how much it is going to impact. In the identification, we have learned how many types of risk are, how any change in any transaction in the asset or liability or any side, how a risk comes into picture. And that risk, when we identify that one, we have to measure that risk. Okay. So before measurement, I just want to tell you that all the transactions happening in the bank are of different nature. Some transaction pertains to liability side, some transaction pertain to asset side, some transaction are pertaining to the, say, we can call this contingent side, or it is out of the balance sheet side. Okay. So basically, meaning what those transactions which are happening or type of transaction are divided into three categories or three books are available where those accounting of those transactions taking place. So sometimes questions are asked about those things, where such accountings are taking place and what are their significance or what are their characters are. So we have to understand that before we go into measurement. Okay. So first thing is, there are three things we should know about this. That first is, a transaction can be booked in banking book, or it can be trading book, or it can be off balance sheet. So there are three books where the transactions happening in the bank for any kind of transactions, they are to be booked either in this or this or this, according to the type of transaction. Okay. So what is this banking book and what type of transactions are recorded or made in this banking book? So basically, banking book means
Sir, you can continue, sir. You can continue. No issue.
hello, suggest?
Sir, you can continue.
No, the screen has been displayed or what?
Huh?
My presentation screen has gone off. Host disabled participants in screen sharing. Why this is?
Sir, just try, sir. Once more, just try.
Okay.
Yeah,
Has it come?
yes, sir.
Okay. So banking book is the transaction where the transaction pertaining to all the deposits, transaction, all the loans and advances transaction, and all the borrowing transactions. Whatever the transaction pertaining to deposits, loans and advances, and borrowings are recorded in banking book. Any transaction of deposit, loans, advance, and borrowing, they will be booked in the banking book. Okay, that is the first characteristic of banking book. Second characteristic is that the deposits or loans and advances and borrowings are considered as one of the things which are normally held till maturity. HTM type of transactions. Any deposit, you say, any deposit, basically they stay in the bank for a certain period. Whether deposit is going to mature or it being, sometimes deposits are taken as premature payment also. But for 1 day or 2 days or 5 days or 1 month or 6 months, they are staying with the bank. So basically, there is a definite period we know. Basically, deposits are normally, we know that they will be staying with us. So similarly, loan and advances. Loans are given for a period, 1 year, 2 year, 3 year, 5 year, whatever it may be. Similarly, borrowings are money is borrowed by the bank for a certain period. It is not that indefinite period money is borrowed. It is period for 1 day or 2 days or 14 days or 25 days, whatever it may be. That means all the things has got a maturity. So that means deposits, loan and borrowings are normally held till maturity. So the term used is HTM. Okay. Now, third characteristic is that all these HTM categories or the deposit, loan, advance, borrowings, the system of accounting followed is called accrual system of accounting. Accrual system of accounting means whenever the interest will be accrued, at that point of time, we will compensate that interest to P&L account. Means in deposit. Deposit normally when the deposit will get the interest. Suppose there is a deposit, say monthly interest is payable. So in that case, we will debit the P&L account monthly, credit the depositor's account. Similarly, if it is quarterly, then quarterly it will be debited to P&L and given to depositor. Like this, the interest will be adjusted to P&L account when the interest accrues. Or suppose depositor wants to take the deposits, entire deposit he wants to premature. So on that day, we will adjust that interest from P&L account, we will debit P&L, credit to depositor. Same thing happens in the loans advances. Normally, loans and advances, all the loans and advances, the monthly interest is chargeable. Interest is charged at the end of the month. That means we are debiting the loan and advances and crediting the P&L account. So borrowing also same thing. Borrowing, suppose is borrowed for a period of 3 days. So after 3 days, when it will be paid to the other person or other institution, at that moment, we have to pay the interest by debiting P&L account. So that means whenever interest is accruing, we are adjusting that interest from the P&L account. Either we are creating the P&L or debiting the P&L. So that system of accounting is called accrual system of account. Okay. Now in this banking book, what are the different kinds of risk that may happen? So basically, there is interest is there. Interest rate is there. So interest rate risk will be the first thing. So rate of interest may change. Due to change of rate of interest, we may have a loss of profit. So due to change of interest, the NIM, net interest margin, may go down. So that is the risk. So if the deposit or borrowing rate goes up, then our NIM is way down. If the loan and advance rate comes down, our NIM will come down. So there is a interest rate risk. Okay. Since loans and advances are there, so there might be credit risk also. There is default risk. Okay, and definitely there is operational risk. Operational risk is always there. Everywhere operational risk is there. But one thing which is not there in banking book is market risk is not there. In this case, market risk is not there because there is no investment portfolio in banking book. Or we can say no market risk is there in the banking book because this book is not open to the market. Okay, so these are the characteristics. You should remember this. Any question may come about this. Okay, now about the trading book. So in trading book, all those assets of the bank which are traded in the market, assets which are traded in the market, basically they are the investment portfolio. They are in the trading book. So we can say this is for investment portfolio. Entire investment portfolio are to be recorded in the trading book. So That means any asset bank has acquired or bank has invested in, they are generally held for a certain duration. Generally held for a short duration, and the position of that duration are to be liquidated in the market immediately. Okay, so here these assets which are traded in the market can be of three categories. Again, remember very carefully, you should remember all these things. I will not repeat it again because question will be asked on this, so please listen carefully. So the investments or the assets which are kept in the trading book, they may be of three types. One is HTM type, which we have already discussed, held till maturity. In certain government bonds, etc., are there, which are normally you have to buy those things and you have to hold them till the maturity. Because those government bonds, you cannot redeem it before maturity. If you are holding it, you have to hold till maturity. So they are HTM category. Next category is called HFT. HFT is held for trading. Held for trading. Trading means both buying and selling. So here, those securities which are kept in this bucket or in this basket, those security, either bank is intending to buy or bank can sell the security. Both the buying and selling both will happen for this type of security which are held in the HFT basket. Last one is AFS. AFS is full form is available for sale only. That means this type of security which are put in this basket, they are only for sale. No buying of this is there. Only sale for sale. The basket AFS where the securities are put, those securities are only for the purpose of selling by the bank. Okay, so there are three types of securities: HTM, HFT, and AF. And we have discussed about HTM, HTM. So even though this type of securities, investment securities will be there. So HTM category of securities, if there are any investment category which are in HTM, they will be accounted for or recorded in the banking book only. Because all the HTM type of securities or liabilities or deposits are there, they will be recorded in the banking book only. Okay. Now, these two, HFT and AFS, they will be in the trading book. Now, we understood this. HFT means what? On buying and selling, both are possible. AFS means only sell will be allowed here. Okay. So, next is what is the accounting system followed? In the HTM category, accrual system was followed. But in case of this HFT and AFS, which are recorded in the trading book, the accounting system is followed, which is called mark to market. The accounting system is called mark to market. Very important to remember this. Questions are coming. Mark to market means each and every day the position at the end of the day of the bank due to investment portfolio, maybe bank may have gained or bank might have lost. So there might be a profit or that might be a loss. This profit and loss has to be adjusted to P&L account on daily basis, not accrual basis. Accrual means as and when, monthly, quarterly. But here, investment portfolio, everything is done on daily basis. You have to gain to be credited to P&L, loss to be adjusted to P&L. So that system is called mark to market system. Clear? There is no problem. So what type of risk available? Since there is HTM category, HFT category, AFC, so all the risks of banking book will be there, as well as market risk will be there. So market risk is another risk which can be there. Liquidity risk will be also there. So credit and default risk will be there. So all the things are available. Trading book, almost all the risks are possible. But in the banking book, market risk is not possible. Any question on this? The third one I'm going to explain is off-balance sheet item. Off-balance sheet item means those are the items like you have non-funded advances like bank guarantee, LC, or derivatives. Then you can have swaps, forwards, futures for a contract. So these are the non-funded advances. Non-funded. So basically non-funded advances means right now they have not affected our balance sheet, but they may become a funded one when the counterparty does not commit its fulfillment. At that time, bank may create a loan or investment on behalf of those type of entries, and it will become a funded one. That means these are the exposure which are off balance sheet exposure, or they are in contingent in nature at the present, but this exposure may become fund-based exposure. This non-fund-based may become fund-based exposure when the commitments are not fulfilled by the counterparty. So, when such thing happens, this contingency adversely affects the revenue generation of the bank. So, depending on the nature of the type of exposure they may become when the commitment is failed, either they become a loan or they might become an investment. So, according to that, if this loan is created, then they will be accounted for in the banking book. If an investment account, it is, say, debit balance is created, then it may become a trading book. Okay, so depending on the type of exposure they may become due to the failure of commitment of counterparty, either they will go to banking book or they may go to trading book. So similarly, according to that, if it goes to banking book, then what type of risks are available, we have understood. If it goes to trading book, what type of risks are available, we have discussed. Okay, any question till now?
So can we say banking book as the balance sheet?
No, balance sheet. So, see, balance sheet is a annual statement where your asset and liabilities are say indicated. What is the amount of asset? But accounting process takes in the ledgers and other way. Accounting process does not take place in the balance sheet. Balance sheet is a summary. Balance sheet is a summary. But whatever the things takes place in the ledgers or journals, so they happen, those are the banking book and trading book. So we can say all the transactions pertaining to all the three may be summarized after transaction takes place. All the three, when it is summarized, this will be summarized at balance sheet, and our balance sheet will become a contingent liability. So it is not balance sheet actually. Okay, any other question?
Sir, could you please again explain, like when a non-fund base becomes fund base, the effect on the balance sheet a little again, sir?
See, bank guarantee. A bank guarantee has been issued by the bank on behalf of a client. Okay, so bank guarantee has been. Now this bank guarantee has been issued on behalf of client X in favor of Y. Y is the beneficiary, X is the applicant, and bank has issued. Now, it is supposed that bank guarantee is issued. Now, X has not fulfilled his commitment to the Y. So, Y can come and to the bank and invoke the bank guarantee. So, they will invoke the guarantee. Whenever bank gets the invocation of guarantee without asking anything to applicant, bank has to make the payment, entire amount has to be paid to Y. So that means whatever security or whatever, that is different thing, but bank has to create a loan and the amount has to be paid. After that, the amount will be recovered from the security or recovered from X, that is different thing. But a loan is created. That means bank guarantee was earlier a balance sheet item. Now, due to failure of the commitment, loan is created, and according to that, when loan is created, the accounting process is to be done in banking. It's like
Thank you.
this
Thank you, sir.
LC or derivative. If such things happen, what is the funded one is created. Based on that type, it will be accounted for in what type of book. Okay. Now, how these are measured? How this risk we have identified and how they are going to measure. Because basically, the measurements are done in three things. First measurement is to measure the variations in earning. It's a simple thing, earning variation. So variation may be plus or variation may be minus. But since we are calculating the quantitative measurement of the risk, so plus is not to be accounted, because whenever profit happens, we do not account for it risk. So only when loss happens, then this risk to be measured. How much loss is happening. So measurement of variations in earning, when the earning is negative, we have to look into the picture. So this earning difference is simple thing, very simple, because you take the deposit side or the loan or investment. These are the three basic things for which bank is either paying interest or earning interest. So, and also borrowing is there. Okay, so now deposit and borrowing both together. Whenever interest change of interest happens, then there is a variation. And when the interest change is adversely affecting the bank, means when the suppose deposit rate was earlier 6%, now it is becoming 6.25%. It has increased. That means bank has to pay additional 2.25%. So it is a variation in the earning resulting in a loss or resulting in a risk. So that can be easily calculated. So we can calculate that 0.25% is the reduction in our net interest margin. So what is this 0.25%? This is the interest rate gap. This is the interest rate gap which has happened. The gap is 0.25, for which our NIM has gone down by 0.25. Okay. Now, in case of loan and investment, again interest is charged. So, interest we were charging say 10%. So that was earning. Now interest has come down to 9.5%. So interest has come down here. So asset side, interest is coming down. Liability side, interest has gone up. So it will affect our NIM. So NIM will be going down due to rate of change interest. So this is also this 0.5 is the interest rate gap. This is the gap. So for such type of thing, there is no problem. Say investment, there will be little problem. But in case of borrowing, deposit and loan, there is no complicated calculation. We can calculate the amount of variation in earning by just knowing the gap of the interest. Okay. But in case of investments, investment, it is very difficult to calculate because these are calculated on a daily basis. Daily basis, and that too in daily basis or in interest rates may change several times. It is not that once in a day it will change. So basically due to that change in the market rate, so we can call it, there is a market rate which is also applicable in the market where investments are made. Due to change in the to fluctuation in market rate, what will happen? The security which the bank has purchased, so the value of the security may go up or may go down. So whenever this value of security is going down, then it is a risky. It is a risk, so that has to be measured. So for measurement of that market value of the security when it is going down, simple interest rate gap will not be enough to measure. So that is a different method. We'll see what are the method for calculation. Okay. Third thing is to measure the losses due to default. So now in case of say loans and advances, borrowings, or in case of say investments, there is a counterparty involved. Counterparty is there. Counterparty here in for loans and advances, counterparty is the borrower. For borrowing, from which institution you have borrowed from. For investment, the issuer of the security is the counterparty. So in case of any of these things, if the counterparty defaults, then bank will have a problem. Because there is a default, so either loan is defaulted, it becomes NPA. So suppose you have borrowing in the sense, suppose bank has lent some money to any institution, that institution is closed or they are not paying you back. In that case, bank will have loss. Similarly, investment, a security which is invested, that corporate has failed, so our security is gone. So due to default also, there might be a loss. Due to default also, there might be a loss which may happen. So all the three things are to be measured. So losses due to default can be easily measured just by simply we can measure just by knowing the fact that how much loan has been lost or what is the loss of investment, everything. So there is no problem in A and C. Measurement of the variation in earning can be measured through the gap of interest. And default, when it defaults, a loan turns NPA, it can be measured. But the measurement of the variation in the market value is totally complicated. And for that, different methods or tools are used that we are going to discuss next. Any question you ask me?
So by market variation, are you talking about the share market, like prices of share market changes, or like something other?
Yeah, basically, see, bank can invest in the shares, bank can invest in the debentures, bank can invest in the bonds. So they are traded in the market, right? So shares, if you have shares, then shares value may come down. If you have debentures, the debentures value might come down. Bonds also, bond by price. So the price of these debentures and bonds may also come down. So in that case, there might be a loss to the bank. So that is called the measuring the variation in the market value of the security. These are all securities. Bank has invested in share, debentures or bonds, whatever it's whatever those securities which are normally traded in the market.
And variation in earning, interest rate change in deposits, no?
That is what I told, na? Due to interest rate gap.
And it may also happen that in loans also there may be changes.
Yes, both loans and deposit, that was I given the example. Loan interest falls, so it is a loss to bank. Deposit interest goes up, So that is, I have given an example. I have told you about interest rate gap. Deposit rate was 6% now. Now it has gone to 6.50. This 0.50 is the gap. Due to this gap, 0.5 is our loss in our net interest margin. Similarly, loan interest, I told you that earlier we are earning 12%. Now the interest rate has come down to 11%. So it has come down. So gap is 1%. So 1% reduction in the NIM has happened. Okay, clear?
Yes, sir. Yes, sir.
Now we'll see how this investment or market thing is measured. Because now what I'm going to discuss and tell you very important, because numerical problems will be coming for that. 100% one or two questions are coming, at least for 2 or 4 marks you will get question for this. So please be focused on this. So that part I told you. Apart from this thing, as I told you, sensitivity is one of the measure and volatility is the other measure. So first measurement of risk in that market risk. So basically all those things normally they pertain to market risk measurement. Normally they are part of market risk. Sometimes DPV might be for the credit risk also, but basically the complication happens in the market risk, that is due to the investment portfolio. So how this risks to be measured? So two major tools are there. One is called sensitivity method. Second is called volatility method. In case sensitivity method, there are two things are to be calculated. One is called max duration. Another is called modified duration. In volatility method, again two things are calculated, which is called BPV or basis point value and VAR or value at risk. So one by one, I will discuss. Be careful and be focused on this so that it will be easier to understand. Okay. Now, what is this sensitivity? Sensitivity means, as per definition, sensitivity measures the deviation of a target variable due to change in single market parameter. So here target variable means what? We are talking about the income. Target variable is our income. So basically we have to see whether income is positive or negative. So our target variable, how it is deviating, whether it is becoming plus or minus due to change in single market parameter. So what are the market parameters? For one single market parameter changes, how it is changing, our income is changing. So that is measured through sensitivity. Okay, what are these market parameters which may affect our income? So market parameters can be anything. If the interest rate changes, our income may come down. If the exchange rate, stock price, market liquidity position, demand supply position, and inflation, all these are different market parameters. So for a single market parameter change, what is the change in our income? That is calculated through sensitivity. Okay. For each and every market parameter change, if our income is coming down or going up, that is the sensitivity based measurement of risk. So we can say that change in market value. So change in market value. Basically, you are looking at market value of the security. Market value due to, say, 1% change in the market rate of interest. So if there is a change in market value due to 1% change in the rate of interest, then that amount, which is the change in market value, would be called a sensitivity based measurement of risk. Say, suppose there is a portfolio, there is an entire portfolio where entire portfolio changes by rupees 1 lakh. It changes by 1 lakh. Changes means either it goes up or goes down due to 1% change in rate of interest. So anytime 1% change of rate of interest happens, the change is 1 lakh rupees. So either change is this rate of interest is going up or down. Accordingly, for 1% change, 1 lakh is the change in the market value. So we can say that here we can say interest rate sensitivity of this portfolio is 1 lakh. So that is the sensitivity based measure. We can say that for 1% change in the rate of interest in the market, the change in market value happens for 1 lakh. So 1 lakh is the interest rate sensitivity for this particular portfolio. Similarly, this can be measured for exchange rate, stock price changes, market liquidity, whatever it may be. So it can be for any single market parameter. So always remember here that sensitivity is the measure of the target variable due to change in single market parameter. That has to be remembered. It is not for the combination of all the things. It is calculated for a single market parameter. Okay. So here in sensitivity, we have to calculate MAC duration and modified duration. How these are calculated, what are their significance, why they are calculated, we have to understand that. So I am going to explain in the next thing. So please be careful and be focused. Any question on this sensitivity? Definition of sensitivity? No question?
No, sir.
Oh, right. So now we see, as for this, we understand that, as I've told, again, I'm repeating, for a banking book transaction, the sensitivity measurement is done through interest rate gap. I have told you. Interest rate gap is the sensitivity of the interest rate margin of the banking book, or the loss or profit due to the banking book can be easily calculated through the interest rate gap. I have already explained that. Similarly, for investment book or trading book, it is the duration which is the calculation done. Duration is the sensitivity of investment portfolio of a trading book. So in case of banking book transaction, interest rate gap is the sensitivity based measure, and for trading book or investment portfolio, duration is the sensitivity based measure. These two has to be understood by you. Okay. Now, there are two major drawbacks of sensitivity measure. There are two major drawbacks are there. Because of these drawbacks, sensitivity measure may not give the accurate picture of your losses or risk potential. Because, as I told you already, number one drawback is what, and number two is that. Number one is that, as I told you, as per this definition, sensitivity measures the target variation or deviation of target variable when there is a change in the single market parameter. So that means the impact due to all market parameters together cannot be calculated through sensitivity. You have to calculate separately, separate type of thing will be resulting. So altogether consolidated market parameters taking in together, because if rate of interest is changing simultaneously, exchange rate might be there where if it is a foreign exchange rate might change. Your equity value might change, stock price might change. So those other parameters may also change. But the change of all the parameters together cannot be calculated in sensitivity. So if you are calculating sensitivity as regards rate of interest, that might be possible that other parameters are also changing, but you cannot calculate that sensitivity for those things because they are totally separate. So that is one of the biggest drawback of sensitivity. Second drawback is sensitivity always depended upon the prevailing market condition. Because market condition means whether the yield rate or rate prevailing in the market is stable or unstable. So in a day, the yield rate might change several times also. And what is the demand and supply position of the market? So it becomes volatile. So sensitivity also move accordingly according to the movement of the market. Because market environment changes frequently. At any point in time, it changes. So sensitivity measure cannot say that if you calculate it in the morning at 10 o'clock, it might not be same at 12 o'clock. Or at 4 o'clock, 4 p.m. you want to calculate, it might differ also. So sensitivity depends on the prevailing market condition, and market always changes frequently. So sensitivity is not a most accurate way of calculating, but you have to depend on certain tools like duration and MAC duration where the sensitivity are calculated. Okay. So we can see now what is MAC duration and modified duration. What is their importance? Okay, so basically this, when we are calculating this, you just focused on the investment portfolio. Investment portfolio, normally we have a feature called a security called bond. So basically the the variation or income of the bond or the change in the price of bond is actually what matters to the bank. Because if we have purchased a bond today at 100 rupees, if you are selling at 102 rupees, that means you have incurred a profit. But tomorrow, if instead of 102, it becomes 90, it means there is a loss. So the bond price might change. So bond price fluctuates according to various factors. So how much that bond price may fluctuate, that can be measured through this MAC duration and modified duration. So we'll see how this is calculated and how this will say. Before that, always remember, in case of bond, always remember, if you have already this treasury management, this chapter might have already discussed to you. So some light might have thrown by the faculty who might have taken this treasury management. Again, for repetition, I'm telling. So bond is a instrument which are normally issued by government or some selected corporates. Okay, so bond means you are investing some amount in the bond. So bonds are issued for a face value. Always there is a face value. Say 100 rupees face value or 1000 rupees face value. These are like fixed deposits. So bond is issued for 1000 rupees for a period. So that is a maturity. So there is a maturity for this bond. Say bond is issued for a period of say 5 years. And definitely there is a rate of interest paid. Say rate of interest paid by the issuer is 4% to you. So this rate is called coupon rate. This is not called interest rate. Whenever there is a coupon rate, means it is always pertaining to the bond. So face value 1000 rupees. It is issued for a period of 5 years. It has a coupon rate at 4%. So that means annual, these are normally coupon rates are annual coupon rate. So annually you will get 4% on this. For 5 years you will receive. That is the return on this bond. That's all. Okay. Now, what is the difference between a bond and fixed deposit? A fixed deposit also are similar. So fixed deposit issued with a face value, issued for a period, a rate of interest applicable. Bank fixed deposit. Same. But here, what is the difference is that, only difference is that these bonds can be listed in the market, in the stock market, so that they can be traded. Traded in the sense, anybody can buy this bond from any other person from the market, or they can sell this in the market whenever they want money. So here only difference between fixed deposit is that fixed depositor can come anytime within 5 years period and they may ask for premature payment. But in case of bond, that pre-closure is not allowed. Anybody who has bought this, he has to hold it for a period of 5 years. So that is HTM, held till maturity. You have to hold it for 5 years period. If you want money, you can sell it to somebody else. So X was holding this. X want money. So X can sell it to Y. X gets money. Now Y becomes the holder of this bond. So he will enjoy the benefit of the bond. So that is the only difference between a bond. Okay. So since they are traded in the market, now at what price X is going to sell or at what price Y is going to buy the bond. So that is decided on a different rate. That is called market rate, or they are called yield rate. So this yield rate and market rate is totally different from this coupon rate. So yield rate or market rate will be different from the coupon rate. Either it will be more than coupon rate or less than coupon rate, depending on the situation. So on that yield rate, the price is decided. Price of the bond is linked to this. This is not the rate at which you will get the interest. It is not that. Only market rate, yield rate is that rate which decides at what price actually a person can sell or the other person is ready to buy. And the market always works in a single fundamental rule, that this yield rate is there. Whenever yield rate goes up, if the yield rate going up, that means your price of the bond has to go down. Whenever yield rate is going down, price is going up. That is the basic rule. Suppose yield rate was 4% earlier. Now yield rate has become 4.5%. That means yield rate has gone up by 0.5%. So always remember, simply, blindly, you can say that price of the bond, if it is 100, then definitely it is going to fall to 90 or whatever, it will fall. Similarly, if the yield rate was 4%, now it is 3.5%. If the price was 100, then definitely price will go up 104, 105, 110, whatever it may be. It is to go up. So this is the fundamental rule you should understand. So yield rate inversely impacts the price. So their yield rate has got a inverse relation with the price. Inverse in the sense direct, it is not directly. Inverse relation means 1 by. Okay, so they have a inverse relation with the price. When yield rate increases, price goes down. When the yield rate goes down, price goes up. This you have to remember. Okay. Now we'll
Sir,
see.
here we are talking about the price of the bonds, no, sir. But
Yes,
whenever
all,
the interest rate goes up, normally the bond price also should go up. Now, what is the logic, sir, between this going adverse?
no, I'm not understanding. What is your question? We are
So
talking
when
about bond only. Okay.
as a bond, when yield rate is going up like 4% to 4.5%, normally the price of the bond also market should go up, no, sir. When
No. That is the peculiarity in the market. Okay. So to see, that's why I told you there are two different rates. One is your coupon rate and one is your yield rate. Coupon rate is the rate at which the issuer is paying you the interest. Okay. So that is decided. That interest you will get. But yield rate has nothing to do with the interest. Yield rate is related to the price of the bond. If the price, suppose bond is 100 rupees issue, the face value is 100 rupees, means 4%. If the coupon rate is 4%, irrespective of the price of the bond, whether the price becomes 90 or price become 120 or 150 or 80, irrespective of the price of the bond, you will be getting, the bondholder will be getting 4% on 100 rupees as coupon rate. So your income is 4 rupees per annum. That's all. Whether price is 80, 90, 120, 150, whatever. This price only changes in the market due to demand and supply and change in the condition, market condition. So that is the, so I will let you know. I think the logic behind it, what I will just give some simple example. Say how it happens. Suppose one, say bond, a bond has been issued. Say that is, say a bond. Say say government has issued this one. Government, central government has issued a bond which was issued. Say it was open from 1st January to say 31st January. So every bond is issued for a period which is a closed-ended thing. After that, issuance will be closed. So this bond, say 100 rupees face value was there. This was issued for a period of 3 years with a rate of interest, say 4%. Clear now? So that means this bond will get 4%. The bondholder will get 4% of coupon rate. Okay. Now this is closed. Now after some days, government has again issued B bond, another bond from say 1st March to 31st March. Say here also price is 100 rupees. This is also 3 years. But here the rate of interest is, coupon rate is say 4.5%. Okay. Now, so here it has been, suppose you have purchased this bond. Say X has purchased this bond. Okay, he is holding. Now these bonds are traded in the market. Now, suppose after some period he wants to say this was in March issued, so he goes to the market in the month of April, and he wants to sell this bond. He wants money, so he wants to sell this bond. So he will say that I am selling this bond. Please pay me 100 rupees, so that I will give you. Are you going to give 100 rupees to him?
No, sir.
No, sir.
Why not?
Because already 3 months is over. The yield has come down.
No. Bond is, it is available for 3 years, na?
Rate of interest 4 and here 4.5, sir. I go
Right.
for 4.5.
So why should you pay 100 rupees? You will tell that another bond is available at 4.5 rate of interest. Why should I buy your bond at 4% interest? I'll get 4 rupees here. Here I'm getting 4.5. Why should I buy this one? I will buy this one. But X wants to sell it. Anyhow, he wants money. So at what price he will sell? So
Less than
you,
100.
Rupees.
the buyer will compare 100 rupees 4.5 interest is I'm getting. So I will compare that same thing here. What will be the price for which I will get 4.5% of this city? So definitely that means when the interest rate has gone up in the market, so interest has gone up by 5%. So normally the question is the bond price has to fall. So he will say that if the price is say 91 rupees, then I will buy your bond. So this 91 rupees, 4% interest might be equal to 100 rupees, 4.5%. So that calculation, how to arrive at this price of 90, 91, 92, that is done to finding this MAC duration or modified duration. So we'll know that what say similarly the reverse case you think. Suppose 4.5% you are getting here interest originally you bought. Now here the rate of interest has changed to 4%. Now you want to buy this. Suppose you buy this bond at 100 rupees, there will be a queue of 100 people or 1000 people to buy your bond. Because you are earning 4.5% here, now interest has come down to 4%. So at that time when the demand is more, you will sell that. Why should I sell it 100 rupees? I will sell it at more price, maybe 105 rupees or 110 rupees I will sell. So that movement, how the price is moving up, that is decided by the yield rate. Yield rate plays here. According to yield rate, the movement of price will change. Yield rate goes up, price goes down. Yield rates come down, price goes up. That is the reverse relation. And how much it is going to reverse, that is decided on this modified duration and MAC duration. Is it clear?
Yes, sir. Clear.
Okay. Now we'll calculate. So be focused on this questions. The 100% questions are coming. Okay. So first thing is example, a 5-year bond, face value 1000 rupees, coupon rate 4% payable annually, yield rate is 4.5%. Okay. So just write it down in a book. So basically the face value 1000 rupees. Simple. Coupon rate is 4%. Yield rate is 4.5%. And this is issued for a period of 5 years. This is the thing. Now, we have to calculate. First step is to calculate MAC duration, then modified duration. Okay. So now simple thing. Here face value is 1000 issued for a 5-year period. So coupon rate is 4% paid annually. It is annually paid. So first you have to make some columns. 4 columns you have to make. First column is time period or T. Second column we can call it cash flow or coupon payable. So we'll see that. So what will be the time? Annual coupon paid. So how many times the coupon will be paid?
5 times.
5 times. So first year, second year, third year, fourth year, fifth year. That's all. Right? So what will be the coupon amount for the first year?
40.
40. Very good. Excellent. And second year?
40.
Second year was 40.
40.
40.
Third year?
40.
40. 40. 40.
40.
But fifth year, how much you will get?
140.
1000 plus 40.
Sorry, 1040.
1040. Because fifth year, you are getting back your principal plus your coupon. Okay. So total will be 1200. That is the coupon you get. Now, see, suppose you have bought this bond today. Today you have bought, we are calculating this MAC duration for today. Okay. So now, after 1 year, you will get 40. After 2 years, get 40. After 3 years, again 40. After 4th year, again 40. And 5th year, this is the value. But these are the future value. These are the future value. But I am calculating MAC duration to find out what is the bond price at which I can sell so that other person can buy. So the present value of these future coupons has to be calculated first. So you have to convert these future cash flows to present value. So how this present value is calculated? Present value formula is cash
Sir.
flow.
Sir, in present value means the present value at the bond has to be sold, right, sir?
Yes. The present value means suppose you want to sell this one in the market. Yield rate is 4.5%. You want to sell this market so that what is the maximum price you can get, or what is the exact price where the buyer is ready to buy that one.
Okay.
So that is the thing, because these are the future values. But if I buy today, what will be the present value of this 1200? That is the maximum price I can pay, na?
Correct. Okay, sir. Okay.
Okay. So that is calculated as this present value calculation is cash flow divided by 1 plus yield rate to the power t. Yield rate or market rate, whatever it is. So that is the formula you have to apply. So cash flow is, these are the cash flow. T is this time period, and yield rate is 4.5%. So you can convert that 4.5 by 100. So 0.045. Now calculate the each PB. Calculate the first PB in your calculator. Do not use mobile phone. Use a separate calculator. Just do the first one and wait. I will tell you how to do second, third, and fourth. So first one is simple, 40 divided by 1.045. This is the first one. How much this answer is coming?
38.27.
38.27 or 28?
28.
28. Okay. So do not do anything if 38.27 is there after doing this thing. Just press equal to. You will get the second answer. Just press equal to in the calculator.
36.63.
Very good. Again press equal to.
35.05.
Okay. Again press equal to.
33.54.
So up to this is possible because cash flow changes for this is 1040. Okay. Up to this, till the cash flow is same, you can press equal to get these things, because while pressing equal to, the T becomes 2, 3, 4 like this. Okay, now you have to calculate for 1040. What is the amount? First, you have to
834.55.
834.55. Okay, now give me the total of all this present value of the cash flow. What is the
978.05.
978.05.
0. 5.
Okay, fine. Anybody asking any question?
Sir, can you explain 834.50 how it is come?
Because you have to calculate 1040 divided by 1.045 to the power 5.
Okay, sir.
Same formula. This formula we are calculating. Okay.
Okay, sir. Thank you, sir.
Okay. Next one is, next column you have to calculate, which is called PV of time weighted cash flow. This fourth column, PV of time weighted cash flow. This means simple, whatever this column amount multiplied by corresponding T. So first one is 38.28 multiplied by T. So it becomes 38.28. Next one becomes 36.63 into 2. So what will be that? So like this, you calculate all the 5 and tell me the total. This is simply PV multiplied by T.
Can you explain PV? My connection was just disconnected. So please, can you explain once again?
Here it is, formula is written. You apply the formula. What is the formula is written? Cash flow divided by 1 plus market rate to the power T. You put the figures there, you will get the answers. Simple. It is only formula. You apply the formula. Cash flow, you know. Yield rate, you know. Apply the formula. T, you know.
From the exam point of view, all this will be given now, sir, like cash flow, yield rate, so and so things now. Sir.
Question was this. From this we have arrived at all the things. Question was this.
Okay.
Sir, 4523.60.
4523.60. 23.60. I will take it as granted. Anybody can confirm this is the total amount?
Yes, sir.
Yes,
Okay.
sir.
Okay, fine. Now, suppose we say this is B and this is A. This present value is A and present value of time affected cash flow is B. Now, MAC duration or simple duration, we can call it MAC duration or simple duration equal to B divided by A. So how much it is coming? B divided
4.625.
4.63.
62.
6 to, you are telling 5, na? 6 to 5 you told, na?
Yes,
No,
sir.
so-
Yes, sir.
So 2 decimals I am taking is 4.6.
4.63.
And this MAC duration is always represented in years. It is for a time. Because here we have taken the time weighted divided by PV. So it is a time, 4.63 years. Okay. Next, I will explain what is the significance of MAC duration. Then we'll go to modified duration. Till now, anybody having any doubt, please tell me in this calculation.
తీసుకో పడతా బుట్టి పొద్దునే మా అమ్మ చదువుకుంటుంది.
Sir,
Sir,
for a
it's
bond,
very
this
much-
market price, usually buyers will quote, sir, or how, sir, that market price?
So it will be, see, market price will be decided. This calculation will be there and it will be there in the, can you please, who is this actually? Please, can you please put your mic off? Madhuri, please. Madhuri, can you please mute your mic? So basically, this price listing is done in the stock exchange. So according to the calculation, there will be a display in the board. This stock price at this bond price at this time is this much. That's all. So
Okay.
this price is say 978.05. This present value is the price at which you can sell it and the other person can buy it. So here in the market, it will be displayed that this bond, today's price is at this time 978.05. So if you want to sell it, you will get this much price where the other buyer can pay you this much. They will not pay you single paisa more than 978.05. Present value is the price at which the person wants to buy it, because the yield rate is 4.5%. That's why the value has come down, because he has to hold this pay. And what is this 4.63 years? You should remember that a person who is holding the bond at today, so today's present value is 978. Suppose I am holding this bond, or anybody who buys it, he is holding this bond. So this 4.63 year means he has to hold this bond for minimum this period, which is always less than the maturity of the bond. So it cannot exceed, so max duration cannot exceed the maturity of the bond period. So he has to hold this bond for a period of 4.63 years to get or to receive the present value of the bond at the market rate of yield rate of 4.5%. If the yield rate further changes, again you have to calculate entire thing, because here yield rate will change. So according to that, PV will also change. So that means the person who is holding the bond, he must wait for a period of 4.63 years to get the present value price at the current prevailing market rate. That is the significance of duration. Is it clear now? So that we can go to the modified duration. Okay. Now
whether this max duration, whether for selling of the bond also will be calculated like this.
Pardon? I could not get. Why?
For the bond, if he wants to trade in the market, if he want to sell in the market also, whether they will calculate this max duration, what is the remaining tenor or something like.
Yes, that's what I told you, na. What is this PV? PV was 978.05. That means today's price is 978.05 only. You can sell it. Other person will buy it.
Okay. So for
That's
example, if the questions will be asked like this, after 1 year holding, if he wants to sell in the second year, what is the remaining tenor for
yes,
the
that time the T will change, na? We have calculated T as 1, 2, 3, 4, 5 because that's why I told you today we are calculating. From today we are calculating for a period of 5 years. So always T changes. T is the residual maturity. Suppose somebody has purchased after 1 year. For him, only 4 coupon will be payable. Now, 1 coupon has been already paid to the earlier owner. The second buyer who purchases after 1 year, he will get only 4 coupons. So that time, residual tenor will be 4. 4, so 40, 40, 40 and 1040 will be there. So accordingly, PV will change. Time weighted will change. So PV price and this will change. So max duration will also change.
So
are you getting me?
PV first year will start with 36.63. That is second year PV only we will start. We will calculate first year, but that already paid. So second year onwards we will calculate, right? So
that's what I'm telling. Na? See, suppose here 5-year bond, we are calculating at the starting of the year. Suppose after 1 year, suppose this person X was holding, after 1 year he has sold it to Y, say A. A has bought it for after 1 year period. Now residual maturity is how much? 4 year, na?
Yes, sir.
4 year means A will get 4 coupons. A will not get 5 coupons because first coupon has been already received by X. So 40 rupees already paid to X. Now this 40, 40, 40 and 1040, this will be received by A. So your PV will change and PV into time will change. So all things will change now again. Yes or no?
Okay. Yes, sir. Yes, sir.
So that is the calculation. So the T is nothing but T is the residual maturity of the bond. How much time is left? Clear?
Sir, there's one question. Sir, say I have bought it in the second year and I calculated that the 4.5% I'll receive say after the completion of the 5 years. Say in between.
No, well, 1 minute. So 1,000 rupees, 4% coupon rate, 5-year bond, 4.5 is the yield rate.
Yes.
Now tell me, you have purchased on the second year, means first year coupon you have not received.
Yes, sir.
First year coupon is received by the original owner. So you have left with 4 coupons.
Yes, sir.
Now tell me.
Say if the say the rate of interest changes in the 4th year. So then
what is the change you tell me, na?
Sir,
this changes, na? Anytime this changes, your PV will change because PV is calculated as cash flow into yield rate to the power T. So if the
Yes, sir.
yield rate changes, every time this PV will change.
So I
when
have to recalculate. That's what I wanted to
yes,
ask you.
anytime yield rate changes, you have to recalculate to arrive at the PV. So
Okay, sir.
yield rate might change 5 times in a day. So every time yield rate changes, your value will come up or come down according to the movement of yield rate. Is it clear now?
Yes, sir.
Clear, sir. Clear.
So now MAC duration we have arrived. MAC duration
Sir,
was 4
excuse me, sir.
points.
Excuse me, sir.
Yeah.
Sir, in present value column, can you explain that fifth figure, sir? 834.55. I'm not able to get.
What was the cash flow in the 5th year?
1040, sir.
1040. Divided by 1 plus yield rate to the power T. So what is this? 1 plus yield rate is how much? 0.045?
1 plus 1.045.
1 plus 0.045 to the power 5. Simple thing. So you calculate 1040 divided by 1.045 to the power 5. So you'll get 834, whatever the result was. The formula I have given you.
Sir, 995.21 is coming, sir.
First, you tell me 1.045 to the power 5, how much you are getting?
Sorry, sir, 1.045.
To the power 5, how much you are getting? Answer.
Sir, how to do, sir, power 5?
That is again, how to do you do not know, and you are telling 995. How it is coming? Which calculator you are using?
Sir, normal manual calculator, sir.
Manual means which company?
Magnus.
Huh?
Magnus.
Okay, the earlier cash flow thing was coming right. Okay, correct thing by pressing
Yes, sir,
equal
yes, sir,
to
yes,
your.
yes.
Okay.
Yes,
Okay.
Equal
okay.
to its came right.
Okay, then just press 1.045 multiplied by 1.045. How much you are getting?
Sir,
Are you getting?
1. Yes, sir, 1.092.
This you are getting? 1.09.
Yes, yes, sir.
Now then press equal to. So this is the second. This is the square. So press equal to, you'll get a number. Press equal to, you'll get a number. Press equal to, finally you get how much?
Sir, 1.302.
No. How it will be? I am getting 1.24618.
Yes, sir. Sir, 10 times I have to.
I have written here. You see the screen now. First one, I have writing in the screen. Please look at the screen. If you are getting this one, press equal to, press equal to, press equal to. Simple. I am getting this much.
So does it depends on the calculator, because after pressing equals to, I'm not getting PV, and at the same time I'm not getting this one also to the power 5.
So you throw that, you throw that calculator, you buy a citizen calculator. Your calculator is not performing well, so what I can do, tell me? It will take a lot of time to calculate. Nah? You go on calculating, then this multiplied by again 1.045, whatever the result comes, again multiply. That way you will get it.
Sir, yeah, it came, sir. 1.246 it came, sir.
The 1040 divided by this, how much you are getting? Simple formula is there. You have to calculate. You are asking, you are already taken 5 minutes time. So how can I complete the class by such things? These are simple mathematics.
Sir, it came, sir.
So,
came, sir. Came. Thank you.
MAC duration we have calculated so how much? 4.63 years. Okay. Now, second step is calculating modified duration. Why this is calculated? Because if you get the modified duration, we can calculate what will be the price of the bond when the market rate changes. How much it is changing, depending on that, we can easily calculate how much bond price will go up or go down. So next step is finding modified duration. Modified duration is formula is, you write it down, don't ask me again. I'm just writing the formula. You after 5 minutes again you will ask what is the formula. I cannot explain. Okay, there is no time. Already I have taken a lot of time. MAC duration divided by 1 plus yield rate divided by K. Now MAC duration we know this is 4.63. Here also we know yield rate is 0.045. Now what is K? K is whenever the question is given, in the question we have seen that the coupon rate is payable annually. When the coupon rate is payable annually, means every year we are getting 4% of that 1,000, so 40 rupees. So if the coupon is paid annually, then K becomes 1. If it is semi-annually or half-yearly, K becomes 2. If it is quarterly, K becomes 4. If it is monthly, K becomes 12. If it is weekly, K becomes 52. So K is decided on the frequency of the coupon payable. So here it is 1. So we can say 1. So what is the answer now then? What is the modified duration?
4.43.
4.43. This is a number only. This is not in years. Okay. This is a number. MAC duration is represented in years. Modified duration is simply a number. 4.43. Now, how we are going to decide how we will calculate the price change? So, in the question we have known that, so the yield rate was 4.5%, right? In the question, yield rate of 4.5%, that's why I've taken. Now, suppose question says that the yield rate changes to 4%. Earlier yield rate was 4.5. Now yield rate has come down to 4%. So what is the change? What is the change? Change in a yield. So we can say change in yield is how much? Change in is
0.05.
Minus 0.5.
So it is minus 0.5. Okay, somebody has told that. So change is minus. Change is minus 0.5. Okay, suppose they will say that yield rate was 4.5%. Now yield has changed to say 6%. So in this case, change is how much?
Plus 1.5, sir.
Plus 1.5. Okay, so now according to this change, we can calculate the price of the bond. So what is that formula? Formula is, suppose, formula is percentage change in the price of bond equal to this. What is the percentage change in the price of bond? Equal to, the formula always starts with a minus. Always remember, this formula starts with a minus because of that inverse relationship. Minus modified duration multiplied by your yield change. So for the first one, how much it will be? You tell me.
Minus 2.25.
2.215.
So that is a minus or plus?
Minus.
Plus, sir. Plus, sir.
Plus.
See, always I told you earlier, when the yield rate is coming down, it has to be a plus. Market price has to go up. So it has to be a plus. Minus into minus is a plus. How much? 2.215. 2.215%. So that means if the change in the yield goes down by 0.5%, your bond price, suppose 1,000 rupees was there, so bond price will be 22.15. So it will go up. So 1,022.15 will be the bond price. Clear? For 100 rupees, it is 2.215. So 1,000 rupees is 22.15. So bond price will increase from 1,000 rupees to 1,022.15. Similarly, second one, how much will be the answer? The second one.
That is 6.45.
Again, tell me the plus or minus.
Minus.
6.645.
6.65.
645.
645. Okay. So now you can calculate how much, if the interest rate goes up by 1.5%, what will be the price? Price will be 1,000 minus 66.45. So it will be
993.3.
993.55. So how this MAC duration and modified duration are important to find out the price change. Can you calculate if the question comes?
Yes, sir.
What is the yield change?
Huh?
What is the yield change?
Yield was 4.5, now it has to 4. How much it has changed?
0.5. Minus 0.5.
If your gross salary was 20,000 last month, now it is 21,000. What is the change? Can you calculate the change?
Okay, sir.
Okay.
1,000.
Okay, any doubt on this? Because if MAC duration question is asked, you will get a question of 1 mark. If modified duration question is asked, so either a question will be 2 marks question or it can be 1 plus 2 mark 3 marks questions.
Sir, can you explain how is it 2.25?
How?
2.25. 2.25.
Huh?
Modified
Where is
duration
that?
plus yield change.
No, I'm not getting. I have explained anything. What is your question?
How it is 2.25 km. Modified duration into yield change. Yield change how much?
What was the question? For the second one you are doing?
Yeah, yes.
Second one 4.5 to 6%. What is the yield change?
1.5.
No, so multiply that by 1.5 only, na?
Okay, sir. Okay, thank you. Thank you.
Any other question is there? You ask me. Otherwise, we can end it today. It's already time. 7 o'clock.
Sir, just one more question. Sir, can you, this 2.25 was on the base of 100. So for 1,000, then it became 22. For 1,000 rupees bond, it becomes 22.15. Correct, no, sir?
Correct.
Okay, sir.
Suppose here for calculation purpose, I have given the face value as 1,000. In the examination, they will not give as 1,000. They will give price was 975. So you have to calculate that on 90, because 1,000 I have given for easier calculation immediately. So whatever the calculation is, so you can calculate. Suppose it's 2.25% coming down. 975 was the original price. How to calculate this one? So you have the price is coming down by 2.25%. So in 100, 2.25, in 975, how much? So 2.25 divided by 100 into 975. That is the calculation. So you get the price.
Yes, sir.
And in the next sum, like 6.645 is the change, no? So 1,000 minus 66.45, no? So it is 933.55, isn't it?
Whatever it may be, 1,000, how much it is? You are telling 1.5 means 66, 4.43 into 2.215. So it will be 5, 4, 6, 6 point, so 66.45. 6.45. So you reduce 66.45. So minus means how much? 55. So 933, right?
933.55. Yeah.
That is the correct. If no question, then we can stop.
Sir, can we get the slide of these questions, sir?
Yes, all the slide will be given. As I told you, entire slide what I am showing it after completion of risk measurement module, I will provide this slide. No issue.
Another example for solve. Can I get any? Sir?
You have got ID and password for IVS Begin? In the,
yes, sir.
Yeah. So you
yes,
go
sir.
there. So many problems have been posted by me. You do those problems.
Okay. Yes, sir. Thank you, sir.
So there will be more than 200, 300 problems available of different nature. So after you complete the risk management, you can do the problems easily. Because all
Yes,
the
sir.
problems are there. Say 20 question, 50 question will appear in that online. So you will get so many questions. So after completion of the module, you can attempt those things. If any doubt is there, you can ask me. I will explain. So many questions are. Okay, then see you next class.